right, welcome back. You're watching The Money Show on ET Now. We just concluded our conversation with Mr. Mukesh Agarwal, the CEO of NSE Indices Limited, to talk about what really led to this frenzy in the last couple of years, particularly in the Nifty 50 ETFs, which has been one of the most popular benchmarked, mutual fund in the entire ETF category. Well, now let's talk a bit more about how ETFs as a category fit into your portfolio. How should you invest in them? And when the going gets tough when you're choosing between an actively managed fund and an ETF, or between actively managed funds, maybe that's where an ETF as well does come into consideration. So let's discuss this entire product with one of the largest AMCs in India. Vishal Jain, the head of ETF with Nippon Life India AMC, joins us now on the show. Vishal, really appreciate you joining us today on ET Now. So the last couple of years, what have investors, clients been telling you? Where has their interest been? Is it towards the actively managed pack, or is it more towards the ETF pack? Because one thing's for sure, in the last few years, there has been increasing interest in passive investing, and an ETF is a great way to sort of deploy the principles of passive investing in mutual funds.
Sure. Good evening to you. And well, in the last couple of years, I think there have been two triggers, due to which we've seen a lot of interest coming into, ETFs such as index and index funds, that is passive products. If you remember way back in 2018, SEBI changed two, important guidelines. The first one was relating to performance benchmarking, where all mutual funds were now supposed to benchmark their schemes versus the total returns index as compared to the price index, which was being earlier used. Now, the difference between the total returns and the price index was basically the dividend yield, which for the Nifty, if you look at the Nifty index, the dividend yield is approximately 1.25 to 1.5%. Now, that was being shown as alpha by schemes, which in that sense, the benchmarking was wrong, which SEBI corrected in 2018. The second important trigger was the change in guidelines which led to scheme categorization, where it was clearly defined as terms of what is a large cap scheme, what is a mid cap scheme, what is a small cap scheme. Because on earlier occasions, a lot of, for example, large cap schemes had nearly 35-40% exposure in mid caps, and they were benchmarking towards, say, the Nifty 50 or the Nifty 100, which in that sense benchmarking was wrong. When these two things were corrected, and when data started coming out, it obviously started showing that most active fund managers were underperforming the benchmarks, and that's what led to a trigger and a flurry of money coming into passive products like ETFs and index funds, because investors started realizing, look, what's the point of paying an expense ratio of 1 to 1.25% to an active fund manager when you can buy the best companies in India at an expense ratio of just 0.05%. So that was a big trigger that led to money coming into passive products like ETFs and index funds.
Oh yeah, absolutely, and we are seeing it even in the last couple of months. Vishal, even though what the AMFI data has been suggesting is that there is, the net inflow number. Actually, the last 2 months have actually seen a net outflow from equity mutual fund schemes, but ETF schemes have still been seeing net inflows consistently for the last 4 months, which as well is something that's pretty encouraging. And yeah, like you mentioned, expense ratio, which is obviously like almost a percentage point higher, or maybe more than that, for actively managed funds versus they are for passively managed funds like an ETF. So do you think that, Vishal, for maybe individuals who have a lower risk appetite, they do not want too much volatility in their portfolio, if they have to choose between, let's say, Nippon India's large cap fund or Nippon India's Nifty 50 ETF, would you recommend them to go for Nippon India's Nifty 50 ETF?
Well, it depends on each individual's, risk profile and what his objectives are. What we tell people is that, look, an active and a passive strategy has its own merits, and both can kind of coexist in your portfolio. So what we tell people is that, look, you can split your portfolio in a core and satellite approach. Now, your core basically, what is the objective of you getting into equity? Your objective of getting into equity is to beat inflation. And if it is to beat inflation, you should first actually get the beta of the market. So the beta of the market is nothing but the index. So a way an investor can look at it is in a core and satellite kind of a way, where 75% of his portfolio can be a passive product like an index fund or an ETF, and 25% could be an active manager of his choice. Now, the same investor might be wanting to take even more risk and might feel that, look, there might be active fund managers who might be able to beat the index. I mean, he can do the opposite, where core of his portfolio can be 75% active and 25% passive. So it just depends on the risk return, profile of an investor, and what his objectives are in life.
All right. Vishal, I was just going through the wide portfolio and the array of ETFs you have, or Nippon India essentially offers. It's very interesting. You do have from the broader markets, but interestingly, you also do have ones that are tracking individual sectors. The biggest advantage of an ETF is that I can buy or sell it anytime on the exchange, right? It's an exchange traded fund. Now, for the Nifty 50, yes, I'm sure the market as well is pretty deep. But what would you say for the others? You have the banking and IT and so on and so forth. If you have to talk to your viewers, is there liquidity comfort over there that if the viewer wants, he can just find a market to sell off that ETF? Again, I'm not talking about the Nifty 50 or the Sensex ones, which I'm sure immensely, any which way is very popular and you can find a market. But for the others as well?
Well, in an ETF, the liquidity of an ETF comes from the underlying shares that it is investing in. So as long as there is liquidity in the underlying shares, there is enough liquidity on the ETF as well. Especially our banking sector ETF. I mean, luckily, because bank futures is very liquid, that automatically lends enough of liquidity even to the ETF, because any market maker who is providing two-way quotes can easily hedge his portfolio, with a bank future. So banking ETF is extremely liquid. I mean, investors can do as much as they want. We've seen volumes even going up to 7,500 crores a day. I don't see an issue at all in terms of liquidity. An important product that we launched just 3 months back, which is the Nifty IT index, which we launched. It's already crossed about 500 crores. And in a short span of time, I mean, IT luckily has done well, and it's grown nearly about 30% in terms of returns. So both these products have a good future. And the reason why we've launched these sector indices is simply because of the fact that both banking and IT are the two largest sectors in the Nifty index. And because of their size, we had a lot of demand coming in for these products. I mean, banking ETF is already about a decade old. So, and the Nifty IT ETF is only about 3 months old, but it's already got, I mean, we're very excited that, it's already crossed the 500 crore milestone.
I want to talk to you actually a little bit more about your Nifty IT as well. What timing really to launch, a fund like that? And I'm sure it's rewarded you very well in the last couple of weeks. By with this whole with the whole rally being witnessed in IT stocks, whether they are in the mid cap names or even the big four or the big five. Again, my question will be more or less similar to the one that I asked you at the beginning. How would you essentially pitch a thematic fund to investors and viewers? Because it can get a little tricky. Thematic funds are all about timing it, etc. For if people had subscribed to your Nifty IT ETF, I'm sure they're very, very pleased with the returns they're sitting on. But again, if there was an FMCG fund, then again they would be a little displeased, right? So again, choosing between actively managed and the thematic options in the ETF, how essentially would you go about investing?
I mean, again, follow the core and satellite kind of an approach. I mean, firstly, be clear about what your objective is, in your portfolio. And, based on that objective, you can invest in different types of products that are there, whether they're active or passive. Passive products, the best thing is that, they're simple, they're transparent, you know exactly where you're putting in your money, they're low cost, and they're easy to get in and get out. I mean, you know exactly what price it is trading at. In fact, as a large ETF fund house, we even disseminate our our real-time NAVs on our website called nipponindiaetf.com. Investors can go onto that website, look at what is the fair value of the ETF at that point of time, and accordingly buy and sell in the market. So it's extremely transparent. I mean, it has its own benefits. So as I mentioned that, both these products can kind of coexist in your portfolio. Why would I kind of have an ETF in my portfolio? Because it's just simple. I mean, I don't need to sit there and choose, which fund manager is going to outperform, which sector is going to do well, which stock is going to do well. It's just, kind of fill it, shut it, and forget it. Invest in these ETFs. You're investing in the best companies that are there at an extremely low cost. I mean, what could be better than that?
Oh yeah, absolutely. It's sometimes really easy as well to essentially invest in ETFs. Liquidity, simplicity, transparency, and all of this coming in at a lower cost. Even the expense ratio is much more lower. Easy to trade, like I already mentioned, and again, professionally managed. Despite the fact that they are charging you obviously a fraction of the cost. So that is something that is great. There's often a myth that people speak about, and that is that there are no dividends, that an ETF offers. How would you, Vishal, firstly, if you could either debunk that myth or confirm it, and why the structure works like that?
So in an ETF, we cannot have two plans, which is a growth plan or a dividend like you can have, in a normal mutual fund unit, because it's a listed product. I mean, there can only be one ISIN. So that ISIN is a growth. So whatever dividend is received from the underlying companies that we invest in is reflected in the NAV at any given point of time. So in a sense, you are getting that dividend. The only thing is it is reinvested in the companies and in the basket, in the underlying basket that is there.
Would you recommend, Vishal, that if there's an absolutely novice investor or a new investor who wants to kickstart his investing journey, who wants to deploy his money into the equity markets, that he start off, with a large cap ETF, or it's really fine. One can do so even with, let's say, a Nippon India large cap fund.
No, I think an ETF makes sense because, at the end of the day, I think cost is a big factor. And the fact that, a novice investor is not very sure, doesn't know how to, may not know how to kind of analyze which fund manager is good, which scheme is good. At the end of the day, what is he looking at? He's looking at investing in the best companies that are there in India. And why is he investing in that? He's investing in the best companies in India because he believes in the India growth story. I mean, it's a very simple objective that he has to achieve, and something like a Nifty ETF can achieve, can fulfill that objective.
Vishal, just before I let you go, let's sort of wrap up all the ETFs that Nippon India offers. I understand it's one of the largest varieties, actually. I think you're one of the two or the only one that actually offers a Nifty IT ETF as well. So let's just wrap up by what are your offerings in that ETF universe, for our viewers. Because again, there's another myth that, Nifty ETF will just give you the benchmark exposure.
Well, we manage 19 ETFs, and across equity, debt, and even commodity. Some of them are the oldest and the most liquid. I mean, we command nearly 75% to 80% of the volumes of ETFs. Across India, we manage about 29,000 crores. Across these 19 ETFs. So investors can choose from a whole array of them. Whether they are, large cap ETFs like the, Nifty and the Nifty Next 50. So the Nifty ETF is what is popularly known as Nifty Bs. The Nifty Next 50 is what is popularly known as Junior Bs. And one of our other very, known products is Gold Bs, which is, crossed 5,000 crores in AUM in recent times because of the demand, for the gold ETFs. And so I think these are three products which have a lot of traction and have a lot of visibility with investors. We have a number of other thematic indices which are there. A couple based on sectors, as you said, the banking sector and the IT sector. And we have the CPSE ETF, which is, a basket of blue chip, central public sector sector undertakings. So we have a whole array of ETFs that investors can look at. They can come up on our website and choose whichever ETF kind of makes sense.
All right. Well, Vishal Jain, thank you so much for joining us today on ET Now, and talking to us about the wide array of ETFs that Nippon India as well offers, not just Nifty 50 and Sensex, but even Nifty IT, Nifty FMCG, Nifty Banking. All of these, are some of the ETFs that Nippon India offers. And yeah, again, you look at the core satellite method of investing. You look at your risk objectives, your time horizon, and then consider how much you want to put in, in the markets via an ETF, and how much should be via, an actively managed fund. Well, for now, we'll do one thing. We'll take a very, very short break right here on the show. Don't go anywhere.